Okay, so in today's lecture, obviously we're going over a example. So the entire lecture for this first period is going to be the example 11.11 in your blue textbooks. So this book here, it's going to be page 145. So page 145 is the page that we're going to be dealing with. Now, if you don't understand something, you have to put up your hand and no, there's no update about whether the exams are going to be on campus. There hasn't been a decision made yet. So if you don't understand something, you have to put up your hands. It is a slightly more complex example. And the reason why we sort of selected this example is because it's complex and we want to try and give you a feel for what you might be getting in your exam or tests or that sort of stuff. So yeah, so what I've done is I've taken out the important bits of the question and I've put it on slides, but every now and then I'll refer back to the question. So if you've got your question open, please just have it open, your textbook at least, please just have your textbook open to page 145 and 146, and then it goes on to 147 as well. But just keep that open and I'll talk you through it, right? Okay. So firstly, the required. We have to break down required. Sometimes what happens is, as students, when we get the question paper, we just want to read everything and answer the question. But let's just take the time and break down this required to understand what is being asked of us. Okay. So if you have a look at what this required is saying, they're saying record only the entries in respect of the provision, right, that the employer must make for its contributions. So it's only looking for the provision journal entries, right? So only the provision journal entries and only for the contribution. So it's not a lot of journal entries. So we're not doing gross salaries, right? We're not doing any sort of leave pay stuff yet, right? We're not doing any sort of leave pay stuff yet in section A or part A. We're only doing the provision, and it's only the provision for the company's contributions, right? So not the workers' contributions. And then it says for December. So that's the other thing. We're doing it only for 1 month. So if we find anything in the question that relates to more than 1 month or maybe a year, we need to either think of what you call it, dividing it by 12, right? But we need to also be very careful to make sure that the information is relevant, because sometimes what happens is we get caught up and we start what you call it, using information that might not be relevant to the question, right? So what I've done for us is I've pulled out extracts from the question and I've put it on our slide here, right? While we're busy looking at it, and I'm going to read it for you, I'm also going to be just typing out a poll question while we're busy doing that. So the first important part of the information says assume that UIF and pension fund contributions are paid over on the 5th of the next month. On the 5th of the next month. Now, why do you think, or what does that mean for us when we're processing our journal entries? What is it trying to push us towards? What do we need to know? Now, I'm almost done, and then we're gonna answer that question in a poll, right? So, almost done. All right. So, what is this statement telling us that we need to do with regard to our journal entries, right? So the question is, what does the paid over on the 5th of the next month tell us about our contra account in our journal entries? Okay, so the first option is that no journal needs to be passed. Okay, so that's the first option. The second option says it must be a liability, okay. And then the third option says, there must be bank. We must record it in bank. Okay, so I'm going to wait for everyone to answer the poll, and then we're gonna talk about the poll. So while people are answering the poll, I'm going to continue reading. So if you haven't already answered, please answer. So then it says the gross salaries for December 2017 is that amount, 143,000. So notice they're saying for December, right? For December. Then it tells us the deductions. We've got deductions, we've got income tax, we've got pension fund deductions and UIF, and then finally the net salaries. Okay, now fast forward to point number 3. Let's go down the page on page 146 to point number 3, and we just want to read this part relates to part A. So let's read and see what is they're trying to tell us. It says Jacaranda Limited has the following contributions to the UIF, an amount equal to the employees or the workers' contributions, right? So the company is going to contribute equally with regard to UIF. Now, how much is the UIF? It's 1,430. So if you have a look there for December, it's 1,430. Remember, we are calculating only for December, we're not doing a yearly amount, right? So only for December. So UIF is in effect a short-term benefit, right? Because we're paying it on behalf of the employee. And if the employee leaves the employment of our company, they can benefit from UIF immediately, instantly, right? So UIF is a short-term benefit because of that. Now, the next one is, it says, so the next bullet point under 3 says, to the pension fund classified as a defined contribution plan, 8% of the gross remuneration of the employee. So always in back to 100, we're going to be dealing with defined contribution plans. So that's not any news to us. It then says 8% of the gross remuneration. Now, again, they're trying to be fancy with the words here. What it actually means is the gross salaries, right? Remuneration simply means salaries, but they're just trying to trick to see if you know. So that's what they're doing there. And because defined contribution plans are in their very nature different, right? So remember, when we're recording for the worker, right, we're recording a portion of the gross salary is going towards the defined contribution plan. So what we are recording there is the gross salary and how it's being split up. We're not necessarily focused on the defined contribution plan, right? But here, where the company is contributing, we need to focus in on what the nature is of this expense. Is the nature short term, right? And before the rest of the people joined in class, we were talking about it in consultation. The nature is not short term, because the employee is only going to, or the worker is only going to benefit when they leave the employment of the firm, right, or of the company. So as a result, the nature of a defined contribution plan is different from a short-term employee benefit. Therefore, it must go to a different expense account, okay, because the nature is slightly different. Okay, before we move on to the answer, let's have a look at the poll. Okay, so the majority of people, there's 6 that haven't answered. I don't know what's happening with them, but the majority of people have gotten the answer right? So what they're trying to tell us is that at the end of the month, so at December, at the end, 31 December, we have not paid the person. We're only going to pay them in the next year, which is in 2018, January 7th. What did they say? On the 5th day or the 7th day? 5th day. So on the 5th of January 2018 is when we're going to pay them, right? So at the end of December 31, the amount is still owing, meaning the amount is a liability. The amount is a payable. So that is what that statement is trying to tell us. It's trying to tell us that we need to account for payable. So our contra journal entry, that we know what the debit is going to be. The debit is always going to be an expense, right? because someone is paying out money. Money is wanting to leave the firm, right? So it has to be an expense. So we're going to debit an expense, and the contra has to be a liability. In the case where the company pays the third parties or the contributions, in the case where the company pays it on the end of on the last day of the month, then it would be bank. Okay, but here they're specifically telling us it's not being paid on the last day of the month. It's being paid on the 5th day of the next month, meaning that it has to be a liability. Does everyone understand that? If you don't, please just say something in the chat so that I know that you didn't get that, right? So basically on the poll, everyone's correct, or the majority of people are correct. The 12 that answered that it's going to be a liability, that is the correct answer. Okay, so we're going to end that poll. Right, so we know that our debit is going to be an expense, right? In terms of the expense, okay, so let me quickly explain that again. So the fact that they're saying the contributions are going to be paid over on the 5th of the next month means at the end of the current month, the contributions have not been paid over, right? So because the contributions has not been paid over at the end of the current month, when we are recording it at the end of the current month, it has to be a payable. It has to be a liability. Okay, that's what it means. Okay, so we know that our debit is going to be an expense, right? For UIF, it's going to be a short-term expense because the expense, the worker can, if they need to, they can tap into UIF within the next 12 months, right? So it has to be short-term, but so we're going to call that short-term employee benefit expense account. That will be debited, and then for the pension, we can't put it in the short-term benefit account because the nature is different. So we're going to take it to a separate account called Defined Contribution Benefit Plan Expense Account. That account is, again, it's also an expense account, but we must record it separately because the nature is different. What amount are we going to take there? So let's go to the gross salaries for December, and that is going to be 143,000 times 8. Why 8? Because we told in the question under point 3, we told that it's 8% of remuneration, right? Times 8, and the amount that we get is 11,440. Everyone got that on the calculators? 11,440. So that is the amount that we are going to record. With regard to the contra accounts, we know that there must be liabilities, there must be payables. So this is what our journal entries are going to look like, right? So if you can make sure in your questions, in your answers, that you put down liability clearly, or if you write the word payable, you're going to get the mark. But if this word is missing, if liability or payable is not there, you're not going to get the mark. Okay. So, for example, for the UIF, they said UIF payable or UIF liability, you'll get the mark. I'm not too fussed about whether you write out, unemployment insurance fund, as long as I trust that you guys know what the UIF is. So if it's UIF, just UIF, I don't know whether it's a liability or an asset. I'm not going to give you the mark, right? So just make sure you're very careful about writing down liability or payable. And then obviously pension fund payable is the other account, right? So this is what our journal entries are going to look like to record the contributions. Any questions about these journal entries? Anything that you're struggling with there? Any questions about these journal entries? Okay, if you do have any, you're going to pop them in the chat for me. Now we're going to look at B. So if you look at the required for part B in your workbook, I didn't like the way it was worded. I thought it was a bit circular. So I've slightly reworded it, and this is sort of what you can expect to get in your test or exam. It basically says prepare the leave pay accrued account, right, or leave accrual account in the general ledger of Jacaranda for the year ended 31 December 2017 in accordance with IFRS. Right. So that's the question. That's what they're trying to ask us. Now, I want you to be super, super careful with dates. Right? We're going to start talking. There's going to be a lot of dates here. So I need you to be very careful with the way we work with dates. Okay. So let's try, let's start reading. Right. Now I've got my, where's my highlighter? Right. I've got my highlighter. So it says the average gross pay. Now, when do we use gross pay? When we're calculating what type of leave? Leave that is, what's the word? Leave that something. Pop it in the chat. Leave that's vesting. So there's a question in the chat here that says, sir, can I see how the pension fund payable account is accounted for? What does that mean? So this is the pension fund account. Anyway, maybe you can chat me afterwards. I don't really understand the question. Okay. So gross salaries, we use gross salaries when we're accounting for, so someone said vesting. I would have said vested, right? So not vesting leave, leave that has vested, leave that's already been paid out. And so we're going to account for leave that is paid out with the gross salaries amount, right? So very important, write that down somewhere. Paid out gross salaries, used cost to company, very important. How many times have we repeated that over the last few weeks? Anyway, so now we are looking at, so it says gross salary per employee per working day for the year ended 31 December 2016. So it's important the way they worded it. It's per employee per working day, right? So you know that calculation that we did and that you would have done in your what you call that thing, online homework, where you took 365 divided by 7 multiplied by 5. They've done all of that for us because it's per working day. So we already know there's no sort of calculation that we need to do. It's already done for us, right? So the way they've set it out tells you that it's done. If, for example, they said just per employee, you need to now work it out per working day, right? Or if they said per working day, well, if it's per working day, it's generally per employee. So you need to figure out what exactly are the figures that they're giving you. So here they're being very explicit and they're saying it's gross salary per employee per working day. So you know that they've done all the calculations already for you. So all you need to do now is use it in your calculations. Now, importantly, what date is this on? It's in 2016. It's not in the 2017 year. So go back to our question. When are we preparing this for? We're preparing it for the end of 2017. Notice, yeah, I've highlighted it there. It's 31 December 2017. So we are preparing it for the end of 2017. They are giving us an amount for the beginning of that year. Okay. And that's 520. Okay. So now it says the average cost to company per employee per working day for the year ended 31 December 2016. So what sort of thing are we going to write there now? So in my book, I wrote next to gross salary, next to where we saw gross salary, I wrote paid out. So what sort of thing would I write next to average cost to company per employee per working day? What would you write there? Write what? Pop it in the chat. Right, used or taken, that's correct. Leave taken, yes, that's correct. So that's what I need you to write down there in your question. And then it says, so again, it's at the end of 2016, which is the beginning of our current year. And the amount given to us is there. Now, it says an average accumulated leave per employee transferred into 2017. So when it's telling us that it's transferred into, it's telling us about what? The beginning or the end of that year? It's telling us about the beginning of that year. It's transferred into 2017. So that amount is going to be the opening balance of 2017. Right? It's transferred into 2017. So therefore, it's the opening balance. And how much is that? It's 9 days, but 9 days per employee. Remember, the average accumulated leave per employee is 9 days. So we now, when reading the question, we need to figure out how many employees are there at that date. At what date? 1 January. How many employees are there at 1 January? Okay. So just keep that at the back of your mind. We need to figure out how many employees there are at 1 January. Right. So now we're going to go down to the additional information. Remember the portion with the little table and the gross salaries and stuff we already dealt with in part A. Now we're going to go into the additional information and read from there. So in the additional information, it reads a salary. Sorry, it reads a salary increase of 10% was implemented on 1 January 2017, right? So it was implemented at the beginning of the year, right? Assume that the announcement was made to employees after, now circle after the 2016 financial year. So what is that telling us? What is that telling us about the 2016 financial year? Do we think that the people knew about the increase at the 2016 financial year? No. So if the employees or the workers did not know about the increase at the 2016 financial year, what is missing? There is no what we call an obligation. There's no constructive obligation. There's no present obligation because the workers don't know that they're getting an increase. Therefore, there's no obligation for us to record an increase. But in the current year, there is an obligation because now they know. Okay, so that is why our poll question that you can see now, click on the poll and there's a poll question for us there. It says, what does the statement after the 2016 financial year tell us about the opening balance? Right? What does it tell us about the opening balance? Is there an obligation that we need to record or not? Right? So what are your options? Options is 1, there's no opening balance. Okay, now let's think about that. Should there be an opening balance? There's like a number that we just highlighted now that tells us that there's definitely an opening balance, right? So let's think about that. Then it says it tells us nothing, right? The statement is just useless. We don't know why the examiner put it in the question, right? So that's option 2. Option 3 then says the opening balance will not account for the increase. Right? The opening balance is not going to account for the increase. What did everyone say? So if you have looked, there's still 8 people that are answering, or 7 people. Everyone has basically said the opening balance will not account for the increase, and that is correct, right? So guys, now, please, you need to tell me if you don't get this, right? The obligation was only created after year end. Okay, the obligation was only created after year end. So at year end, there was no obligation. Therefore, the opening balance in 2017 will not have the increase. So the majority of people that answered will not have the increase. They are correct. Okay. So when we record it, we must take that into account. But then what's going to happen just very close after year end? Because the increase was implemented on the 1st of January, by implementing the increase, we've created that obligation, right? So very close to the 1st of January, we need to adjust the provision. You get me? You get what I'm saying? Very close to that to 1 January, we're going to need to adjust the provision for this increase. So the opening balance is not going to have the increase. We established that. But we're going to have to try and pass some adjustment close to the 1st of January when we have to account for the change in obligation. Because we no more owing the workers that old amount, we're now owing them an amount plus the 10%. Okay, everyone got that, right? If you got it, give me a thumbs up. If not, give me a thumbs down and I can go through it again in the chat. Which account will that opening? Well, it's going to be the provision account. So what we're talking about now is how do we compile? So what we're looking to try and compile is this leave pay accrued or leave pay provision account. So the opening balance of that account is the one. Right? So the opening balance of the leave pay accrued account. Okay. Okay. I hope that answers the question. Right. So that's what we're trying to do. Okay. Okay. So point 2 says assume the year has 300 working days. Now, again, the examiner is just, I wouldn't say it's a trick. They're just trying to test, does this person know that these amounts here are 520? So where the blue mark has come up, these amounts of 520 and 56680, do they understand that it's already per working day? So that's what the examiner is trying to test. So that part of the information is actually a red herring, or what we call useless, right? So it's trying to check, do you understand, or are you going to take this 300 and divide it by, or take the 520 and divide it by 300 or whatever, right? So the amount, the information is there, but we're not going to use it because we already have an amount that's per working day. Okay. Now number 4. So number 4 now it's going to start to get tricky, right? So let's pay careful attention. Let's read slowly. So number 4 says each employee is entitled to 15 working days paid vacation leave and 7 working days paid sick leave per financial year. Okay. Sick leave not taken by the end of the financial year is forfeited. Now, what does that statement, that last statement, sick leave not taken by the end of the financial year is forfeited? What does that tell us? What word does that bring to mind? Right? Pop the word into the chat. What word are we going to write down when we read something like that? The leave is forfeited, right? There's a specific word that we need to think about. It's forfeited. What type of leave is this? It's a type. It's some type of leave. Okay. All right. Non-vesting. All right. So this type of leave is forfeited at the end of the year. So can it be transferred into next year? No, because it's forfeited. It's forfeited at the end of the year. So can it be paid out? No, because it's forfeited. So this type of leave is non-vesting and non-accumulative. So people have been saying, yes, both. So people have been saying, it's non-vesting. People have been saying it's non-accumulative. Both are correct. Okay, both are correct. It is non-vesting and it is non-accumulative. But what leave are we talking about? Only sick leave, right? There's 2 types of leave that have been spoken about. Vacation leave, which is 15 days, and then 7 days sick leave. So only the 7 days is non-accumulative and non-vesting. Now remember, like we were saying, this is put into the question just so that we can test whether the student understands what to do with non-vesting non-accumulative leave. And what do we do with this type of leave? Do we create a provision? Or do we pass any journals? What do we do? What do we do with this type of leave? Non-accumulative and non-vesting leave. Pop your answer into the chat. What would we do? What is our job as the accountant with non-vesting and non-accumulative leave? No one wants to answer. Okay, we'll leave that until someone answers. When you guys answer, then okay. So someone said no provision, no additional journals, and someone else said nothing. Both of those are correct. With non-accumulative, non-vesting leave, there are no journals because the cost of that leave is encompassed. It is already in the gross salary. So we don't need to, and because we're passing the journal for the gross salary regardless, we don't need to pass an additional journal. There's no additional journal, and we can't account for any provision because there's no transfer of value. We're not taking the value anywhere. The value is disappearing. It's being forfeited. So both of those are correct. Okay, now let's read 5. Okay, so I'm going to change the slide. Let's read 5. So 5 says, point 5 on towards the bottom of the page of 146 says a maximum of 5 days paid vacation leave per year for each employee may be accumulated up to a maximum of 30 days total accumulated vacation leave per employee. So what is that? What does that mean? That means in any given year, in any 1 year, you're allowed to transfer 5 days, right? But the total amount of leave that you've accumulated must never go above 30 days, right? So that's what they're trying to say. So basically, if someone does not take any leave for a period of, let's say, 7 years, right, which is unlikely, but let's just assume someone does not take their 15 days in year 1, they will the last. Yes, you're correct. So the sick leave has to be mandated by the government, but and generally because it's mandated by the government, employee workers, sorry, companies want it to be non-accumulative because it's basically an extra burden placed on the company. So the company wants it to be non-accumulative in general. Yeah. Okay. But it's like it doesn't necessarily your answer, what you said is correct, but it's not necessarily um, related to what we're saying. So, can it be accumulative? It can, in essence, be accumulative. But will you ever see it accumulative? You're not likely to see it accumulative because if they're already getting vacation leave, why would they give them an additional type of leave called sick leave? It doesn't make sense. So from the company's perspective, it doesn't make sense. Can you see it? Yes, it's possible, but it's not likely. It's unlikely. Okay. Back to 5. Back to point 5. Back to point 5. It says, so I'm reading in the center of the second sentence. So we explained the first sentence. The second sentence says, this accumulated vacation leave will be paid out to the employee on resignation or retirement. So it is what type of benefit? It is a vesting benefit. So it's going to be paid out. So this is accumulative. Why is this type of leave accumulative? Because we are able to transfer it from 1 year to the next, right? This vacation leave now. We're not talking about sick leave, we're talking about vacation leave. This vacation leave is accumulative. We're able to transfer it from one thing from 1 year to the next, and it's vesting because when someone resigns or retires, they get it paid out. Okay, so far we're all on track. It says in accordance with the company's policy, in accordance with the sorry, I've lost in accordance with the company's policy, the payment of accumulated leave will be based on the gross salary of the employee on the date of resignation or retirement. Now, that statement is a sort of a null statement because we already know that when you pay out leave, you must use gross salary. So now they're just telling us, they're reiterating, when you pay out, you're going to use gross salary. Okay, so that's what they're doing there. And then now this next statement is the one that I highlighted, right? So it says the entity assumes that the accumulated leave will be used before the employee retires or resigns or retires. So what is that statement telling us? So what does this mean? On what basis are they going to raise the provision? On the basis that the leave is what? Used or paid out? That statement. Let's read the statement again. The entity assumes that the accumulated leave will be used before the employee resigns. So in what case, so let's just rationalize, let's just think about it. Right? In what case will the leave vest? The leave will vest when they resign or retire. But now we are being told that the accumulated leave is used up before they resign or retire. You get me? You understand what I'm saying? So the basis that we're going to raise the provision on is entirely used, right? So the company is saying there's no split between used and paid out. We are assuming everyone is using the leave, right? So when we raise, we're going to raise the provision that everyone is using the leave. Does everyone understand? Right? Give me a thumbs up if you understand the reasoning behind that. You understand what that means, right? Yes, it is accumulative. Yes, it is vesting. But will it vest? The company is saying, no, we don't think it's going to vest. So at the end of 2016, if you went to ask the company, how much of the leave is going to vest, they're going to tell you none. None is vesting. Everyone is using the leave. Okay. So that's the basis that we're going to raise the opening balance of this provision is going to be raised on the basis that everyone is using it. Now, when we raise leave pay on the basis that people are using it, what amount do we use? Gross salary or CTC? What amount do we use? Type it out in the chat. What amount would we use? Right. So we are going to be using cost to company to raise the total amount of leave. Now, we know that on average per employee, 9 days was brought over. Where did we get that? We got that from the previous slide, right? So we know that 9 days was brought over, but we don't know how many employees yet. So we're still trying to figure out how many employees are working at this company. So that's the policy. Now let's move on to 6. Now in point 6, what they are actually telling us is what actually happened. Okay, so next to that paragraph, that's what I wrote down. I wrote down this is the actual, and 5 is basically what they assumed or what they budgeted to happen. 5 is the budgeted, 6 is the actual. Okay, so now just think about that. In fact, 6 to the end of the question is actual, and 5 is budgeted. So let's think about now what's happening in 6. So it says, so we know, just because we read 5, we know that we're going to raise the provision as if everyone has used it, and we're going to use CTC to raise the provision. Right, got it. So now in 6, it says 2 employees had a combined leave balance of 24 days accumulated on 1 January 2017. Now, let's just stop. We just heard that everyone, per employee, there were 9 days. Now we're being told that there's 24 days for 2 employees, which is basically around about 12 days per employee. How is this possible? Is there an error in the question? How is this possible? This is possible because those 9 days that we got was what? It was an average. Okay, so they were saying on average people have 9 days. Now remember how you calculate an average. When there's an average, there will be some individuals in a population, right? So when you calculate an average, you call that the group of things that you're calculating for a population. So in a population, you'll have some individuals that are higher and some individuals that are much lower. you know, and so they'll move around the average. Not everyone will have exactly 9. There's going to be some that are a little bit more, some that are a little bit less. So here they're telling us the actual for these two people in total, the actual was 24. So that's how we can have an average of 9, but an actual for two individuals of 24, right? So it was the combined total. So when you group them together, the combined total was 24 accumulated leaves. Does everyone understand how we can have 9 average, but 24 actual for these two guys? If you don't, please pop it in the chat now. So the statement goes on to read, resigned during, so these two guys, these two employees, they resigned during January 2017. So would we have known that they were going to resign in the opening balance, which was raised on 31 December? No, we wouldn't have known, because they only resigned in January. It says they left the company on 31 January 2017. The result of their resignation, as a result of their resignation, they forfeited all sick and vacation leave due to them for January. So what sort of leave did they forfeit? Did they forfeit their cumulative leave or the current leave? Right? Because they say for January, the leave that was for January 2017, it is the current leave that they forfeited. They did not forfeit the cumulative leave. So be very careful now how you're reading this question, right? So they did not forfeit the cumulative leave. They did not forfeit the 24 days. They only forfeited the current leave, which came in January 2017. Do we pass journal entries for current leave? The answer is, pop the answer in the chat. Do we pass journal entries for current leave? While you guys are busy typing that out, I'll continue reading. It says, however, all their accumulative leave up to 1 January 2017, so at the beginning of the month, was paid out to them on 28 February 2017. So when is our journal entry? So the answer, someone said, no, we don't account for current leave. That's correct. We don't account for current leave. And the reason for that is it's already included in the gross salary. Right, so when is our journal entry going to be passed? The amount, they left at the end of January, but the journal entry will only be passed in 28 February, because that's when the payout happened. Okay, there's been no further resignations or no further appointments during 2017. Okay, no further resignations or no further appointments during 2017. Okay, so let's turn over and we look at number 7 on the next page. So now I'm trying to build a table here at the bottom. So if you have a look at this table, I'm highlighting the table now. I said 2 people have retired. I'm supposed to say resigned. 2 people have resigned, right? And they had 24 days leave available. They got paid out all of it. How much did they accumulate? They accumulated none, because remember, they forfeited all of the current year's leave. They took over, they didn't use any, right? Because they got paid out all 24 days, and they didn't carry over any to the next year because they're no more employed. So we're trying to build up that table, right? So keep an eye on that table. I'm going to build it up as we go. Right. So the next statement, which is statement, 7, says the remaining 10 employees, the remaining 10 employees. So during the year ended 31 December 2017, the remaining 10 employees used 60% of the opening balance on 1 January 2017 of their accumulated leave. Right. So when it says the remaining, what does it tell us about the total number of employees? How many employees came into the year? How many employees came in on 1 January? What number? Give me a number. What number of employees came in on 1 January? Right, so people are saying 12. That is correct. Right. How did we get 12? It was 10 employees, right? 10, let's call them remaining. 10 remaining employees plus those resigned 2. The 2 that resigned. So 10 plus 2, 12. Okay, so there were 12 employees at the beginning of the year. So when we create the opening balance, we need to account for 12 employees. Okay, so when we create the opening balance, we need to account for 12 employees. Okay, so it says during the year ended 31 December 2017, the following leave, excluding the accumulated leave of the previous year, was used by the 10 remaining employees. So excluding the cumulative leave, right? That's the key part there. So the cumulative leave, they've already dealt with in point 7. They said 60% of the opening balance was used, right? So 60% of what number? 60% of 9 was used by the 10 employees. But we're going to come back to that because that calculation might get a bit tricky. So 60% was used of the remaining of the opening balance for those 10 employees. And then it says if we leave out a cumulative leave, the person, on average, they took 4 sick days, and 12 vacation days. Now, how can just have a look. I didn't produce this in the slide, but if you look at your book, number 9.9 says the company's policy to first utilize a cumulative leave before the current year's leave can be utilized. What state? There's some sort of statement that we use when we talk about such things. Can you give me that statement? It's there's some abbreviation. That sentence is trying to tell us something. It's like an abbreviation, right? So let's read that sentence again. It says the company's policy is to utilize accumulated leave before the current year's leave can be utilized. What type of method of usage is that? There's some type of word that we normally use, right? Some people have got the word. The word is FIFO. So they're trying to tell us that the old leave, the accumulated leave, is used before the new leave. So now I've got a question for you, right? Point 7, it says 60% of the old leave was used. But then when we read point 8, it says 12 days from the new leave was used. So how is this possible? Because we're supposed to have used up all of the old leave before we started using the new leave. That's what someone might think, right? But when we are dealing with many employees, right? We're dealing with many employees, and we're dealing with something called an average. Remember I said with an average, you can have numbers that are above as well as numbers that are below, right? And different employees will do different things. So not everyone is at the average, right? So what they're telling us is the average used to be 9. We're going to come up with a new average just now, but the average used to be 9, right, before the people left. And then on average, they used 60% of those days. On average, they use 60%, right? And then they say on average, they use 12 of the new. So how is it possible? So my question is, why do we have both the cumulative leave and current leave being used at the same time when the company is using FIFO? How is it possible? So the options that you have is, the question must be wrong, right? So sir must have made a mistake, right? Or they're using averages across many employees. Therefore, it is possible for for us to have people still using the accumulative leave while others are already using the current year's leave, right? Is it possible for that to happen? And that's what's being reflected in the numbers. Or finally, it's just too difficult, and we should call Scooby-Doo. Okay, so this is what the responses look like, right? So it's because we're using averages and because we have lots of employees that it's possible for us to have a situation where we're still using the prior leave and using the current year leave at the same time, okay, because we're using averages. Okay, does everyone understand that, or do people not know what I'm talking about? If you don't know what I'm talking about, please can you pop something in the chat now? Right. So let's continue building our table. Right. I know that we almost over with time, but let's just we'll finish the example, then we'll take a 5-minute break. So let's just build up our table. So we've got 2 employees that resigned. Then we've got the 10. Now, what we are told in the beginning of the question was that on average, these 12 employees had 9 days available, right? On average. So our calculation is going to be 9 days, all right? Let me just come to the chat. So we've got 9 days available. And then how many employees? What's the number of employees? We've got 12 employees. So I'm going to say EE, 12 employees. And how many days does that give us in total? It gives us 108 days. All right, so that's how we got the 108 days that you can see here. Okay, so we've got 9 days on average, a total of 12 employees. If you multiply 9 by 12, you're going to get 108. Okay, that's how we got 9 days. But then we were told that the actual for 2 of these employees, the actual number of, not the average, the actual number of days is 24. Okay. So then what is the remainder that is left over for the 10 employees that stayed employed, right? So then we need to say it's 108, okay? That's 108 that we calculated just now. There's the blue line. We have to minus the 24 of the people that left. So the 10 employees that remained actually had how many days in total? 84 days, okay? They had 84 days in total. Everyone got that. If you don't have it, please pop something in the chat now. If you didn't get that, okay. So the 10 employees owned 84 days. Now we were told in the question that on average, okay, 60% of the leave days were used up. On average, 60% of the leave days were used up. So then we say 84 times 60% is going to give us 50 days used up. So how many days are not used up? Pop that number in the chat for me. How many days are remaining? Right? How many days are remaining? Another way that you can calculate that is by saying 84 days times 40%. Why 40%? Because if 60% was used, then 40% must be remaining, obviously, right? So how many days is that? I need a number in the chat. How many days is that? All right, there we go. There we go. Right. So there's 34 days that are remaining. Now keep that number at the back of your mind. There's 34 days that are remaining. 50 days had been used up. Right. Now, so that is that's the prior year, the leave that was brought over from the prior year. Now in the current year, we're told that each person gets 15 days. They only on average used 12. Remember, we're not going to account for sick leave because sick leave is non-accumulative, non-vesting. There's no journal entries. We went through that. So we're only accounting for vacation leave. So they each get 15 days. They used up 12. This on average 3 days per employee. Right? There's on average 3 days per employee. So that is the 3 days that we are seeing there. Okay. Now we've got only 10 employees remaining. Remember, 2 left. So we need to say 3 days times 10 employees is going to give us 30 days. Right. So at the end, in December 2017, at the end of the year, how many days do we have that we're carrying over in total into 2018? How many days? We've got the 34 plus the 30. It's going to give us 64 days. Okay, everyone follow. if you are lost, you have to tell me, because I'm not going to know if you don't tell me, right? So you have to tell me if you lost. Now we're going to create our T account. Okay, so how did we get, so someone's asking, how did we get this 30 days, the current year not used? So each employee is given 15 days. How do we know that? We're going to go to point number 4, where it says each employee is entitled to take 15 days paid vacation leave. So each employee gets 15 days, right? And where's that 15 days? It is here, right? So each employee gets 15 days. Then in point 8, in the second bullet point, I'm going to highlight it on our screen. It says 12 days on average was used up. They used, so how do we know it's used? See, I'm underlining the word used. 12 days on average were used up, 12 working days per employee. So we say each one got 15. On average, 12 was used. So we left the remaining per employee is 3. Right? So there's our 3 days. And then the question is then how many employees we have? We've only got 10 remaining. So 3 times 10, 30 days. Now we've got 30 days from the current year that are unused, right? We need to now add the 34 days from the prior year, right? Remember, we had 84, then we used, so we had 84, then we used 50. So now we've got 34 from the prior year. So we add the 34 plus 30 to get 64 days that we're taking over into 2018. Okay. So let's have a look at our journal entry. Now remember, we are assuming, because of the last sentence of point 5, we at the beginning of the year, we're assuming that no one is going to resign. Everyone, sorry, not no one is going to resign. Everyone is going to use up their leave. So the amount that we're going to use to calculate the opening balance has to be CTC, right? So we come in and we say CTC of 566.80, right? Now, why haven't we applied the 10% increase? We haven't applied it because there was no obligation. Remember that poll question we had? There was no obligation at the end of last year. So at the beginning of this year, there was still no obligation. But sometime on the 1st of January, how did we get 64 days? 6.4 days. Well, we took the 64, which is this amount. Remember, 6.4 days per employee. So we took the 64 and we multiplied it by, divided it by 10. Why 10? Because there's 10 employees. Divided by 10 employees. These are 6.4 days. So that's our calculation. We had 64 days divided. We just went through, okay, you're going to have to come and chat to me how we got to the 64. We went through it twice already. So we're going to have to come in consultations and we can go through it. So the 566.80 is the cost to company, right? So look at your question, it's the cost to company. Then we multiply it by 108 days. Why 108 days? Because we have all 12 employees at the beginning of the year, right? So we're trying to create the opening balance. We can't take into account the 10% increase because, as we read in point 1, the 10% increase was only issued after the year end, sometime in January, probably the 1st or so of January, right? Because it said it was implemented on the 1st of January. So it was sometime on the 1st of January. But the opening balance will not account for it because there was no obligation. Okay? So there was no obligation at that time. So we can't take it into account. So then we say 500, which is cost to company, times 108 days, which is the total of 12 employees, right? And we're going to get this amount of 61,214. Now, during the course of that first day, there was the announcement made, right, of the 10% increase. So now we need to adjust our provision so that it includes that 10% increase. Remember, all adjustments to this provision account has to go to short-term employee benefits expense account, okay? So this is what this journal entry is doing here, where we're adjusting it. We're saying we're taking that amount from there, right? And we multiply it by 10% to get the adjustment here. Now, how would this have changed if we said that the increase was announced before year end, right? And that case we've dealt with before. If it was announced before year end, they've created the obligation before year end. Therefore, the opening balance must take into account that amount, okay? But in this case, they clearly told us the obligation was only after the year had ended. Therefore, we can't take it into account in the opening balance. Okay. But the idea being is that when on the best information that we have, we must have a future-looking provision. The provision must be relative to the future, okay, at all times. So if the obligation had already been created, we would have already had to take it into account. Okay, so everyone's got that, the opening balance and the adjustment, right, for the increase. That shouldn't be too hectic. Now, when amounts are paid out, what figure do we use? Pop it in the chat. When amounts are paid out, what figure do we use? Vested. Okay. Okay, when amounts are paid out, what figure do we use to calculate the value of the amount that's paid out? Do we use gross salary or do we use cost to company? Right, so we're going to use gross salary. So there's 2 employees that have left. In point 6, it tells us 2 employees have resigned, they've left, and they left on the 28th of February. So notice the date of this journal entry is 28th of February. They left at the end of January, but they were only paid out on the 28th of February. So the date of this needs to be the date of the payout, which is the 28th of February, the end of February. They left at the end of January, but they were paid out at the end of February. So the date that we're going to put here is the payout date. So bank, how do we know bank? Because the amount was paid, right? So there's movement of cash, right? So that's how we know the account name has to be bank. Then we're going to take the gross salary, right? We're going to increase the gross salary for 10%. Why? Because the gross salary that they gave us in the question was the gross salary at the end of last year. And we know at the end of last year, they had not accounted for any increases because the increase was only implemented at the beginning of this year. So there was no increase implemented at the end of last year. Okay, so as a result, we need to increase it by 10%, which is what is happening in that portion of the calculation. And we know that they pulled out 24 days, right? So that's where we've got the 24 days from. So we do that calculation and we get an amount of 13,728 Rand. Okay. But now the question remains, at what rate did we raise the 24 days? At what rate did we create the 24 days? What rate did we use? Did we use 520? No. What rate did we use? We used, let me change my color to orange. We used this rate. So we had raised it thinking that people were going to use it. What actually happened was people wanted it paid out. These 2 employees wanted it paid out. So we need to pass an adjustment for the difference in rate. Okay. we need to pass an adjustment for the difference in rate. Now, how do we know whether that adjustment is going to be a credit or a debit? Well, we raised it thinking that we're going to owe it, right? And now we've paid it. So do we owe it anymore? No, we don't. So therefore, we have to decrease our liability. And that is why on the 28th of February, we pass another adjustment journal entry that accounts for the difference between the two rates. Can you see that? Right, so it's 566 minus 80, 566.80 minus 520, because we raised it at 566, but it was actually paid out at 580. So that difference between the two rates also needs to be eliminated, also needs to be taken away, because we no more owe these 24 days. You get what I'm saying? Because we paid them, we exhausted them. So we increase it by 10%, because remember, these amounts that we are working with are the prior year amounts. So there's no increase. And we multiply it by 24 days, because only those days so far, only those days were used up or paid out. Sorry, so only those days were paid out. So as a result, we're going to get that adjustment that's going to decrease the provision. Okay, you get that adjustment that's going to decrease the provision. Okay, any questions so far? Any questions so far about anything that we've covered? Everyone seems very quiet. Okay. Okay. Let's read point 8 again. So it says, during the year ended 31 December 2017, the following leave, oh, sorry, not point 8, point 7, sorry, point 7. During the year ended 31 December 2017, the remaining 10 employees used up 60% of the opening balance. Now, our opening balance, like we said here, was 108 days. So watch where the orange line is appearing now in the table. It was 108 days. 24 days were taken by the 2 employees. So we had 84 days. So out of these 84 days, the 10 employees, the 84 days belong to 10 employees. They used 60% of it, which comes up to around about 50 days. Right. So we now need to account for those 50 days being used up. Why? Because we no more are owing those 50 days. The person has taken the 50 days, so we don't owe anyone those days anymore. As a result, we say 50 days, right? We have 50 days there, times by 566. Why 566? 566 is cost to company, and the days had been used or taken, right? Used up or taken. And remember our rule, when something is used or taken, we use cost to company. So we use cost to company there, and we need to increase it because it's still the prior year amount. We increase it by 10. So there, 31,174 is the number, as the amount, is the value of days that were brought from last year into this year and used up. Okay. And our account name, remember, any adjustments that come out of this provision account need to go to short-term employee benefit expense account. So that's how we got our account name there. Okay. Now, finally, so far we've dealt with these guys, the 2. So I'm going to scratch that out. We dealt with that. We've dealt with the. We didn't really need to pass a journal entry for this, but we did need to pass a journal entry for the 50 days that were used. So we've dealt with that. None were paid out, right? So we don't need to worry about that from the 10, because we've already recorded these 24, right? Now we need to account for the 30 days. Remember, we want a total of 64. So we need to account for the 30 days so that we've got 34 days remaining in the pot. And now we want to add 30 days to it. So how do we go about doing that? Again, our account needs to be short-term employee benefit expense account, which is, we knew that, right? Because remember, all adjustments need to go there. And then we use the cost to company. How do we know to use cost to company? Because the company tells us, they assume that people are going to use up the days, right? They're gonna take the days. So as a result, we must always, in preparing the provision, we must always use cost to company. Okay, so that we use cost to company times the increase of 10% and our 30 days from the current year. So these 30 days are recorded in that journal entry. And then we get 18,704. And then obviously the closing balance is going to be a balancing figure. Now, as a test, let us take the closing balance, right, of 39,901, right? That's the amount. And if we divide it by the cost to company plus the increase, which would look something like this. Right? We take the 39,901 and we divide it by the cost to company plus the increase. The amount that we get is what amount? It should be, according to my calculations, it should be 63.99 days, which is what? The 63.99 days is the 64 here, is the total. So now we know that the entire account is created correctly because we've also worked backwards and double checked our work to make sure that the correct number of days are accounted for in the closing balance. Okay, cool. Now we're gonna, well, yeah, so that's just the thing. That's the account that we already created. So now we're gonna take a 5-minute break. I know we don't have a lot of time, and I'm going to see you back at 14:50. If you have any questions about this section, now is your time to ask. Okay, so 14:50 is when we're going to be back. So good question. So the person says, why have we increased the opening balance by 10%? Because remember, our provision needs to be future looking. So it needs to be relevant to the future. Now, we've raised it in the past, but when the worker uses it, right, it's going to cost the company that cost to company plus that 10%, right? Because they're using it in the future only, right? Remember, they're using the leave in the future. We raised it in the past, but they're going to use it in the future. And because the provision that we are creating is future looking, we must include that here because the actual cost, the actual amount that the company is going to be affected by is going to be the cost to company plus that 10%, right? Remember, this provision is always future looking. So I don't know if that answers the question. Right. Any other questions about this? So you guys are on a break now, but if you have any questions, please feel free to ask. I'll see you back at 14:50. And I'll be here, so just ask your questions. Yes, correct. So we've got the defined benefit plan expense accounts. They are exactly the same as the post-employment benefit expense accounts. We just started calling them defined contribution plan expense accounts because now we know what they are. We know that they're not a benefit plan, they are a contribution plan, and therefore we just started naming them differently. But for our purposes in Back to 100, we're never going to get a benefit plan. We're always going to get a contribution plan. So yeah, so they're exactly the same thing. They're basically the same thing. Just another statement. The reason why we have to say defined contribution plan expense is because it indicates to the marker that you've applied yourself and that you know the difference, right? When you just say post-employment benefits, you might get penalized for marks, but it also shows that you aren't aware that this specific provident fund has been classified as a contribution plan. So it's a bit more accurate. The account name is a bit more accurate if you say defined contribution plan expense account. So yeah, I was just thinking about, why do we need to name it that? It's just more accurate. Okay, while everyone is still returning, we're just gonna start. We're gonna start off going over share capital. So I just want to take you through and just explain a little bit. So share capital is going to be a topic that is going to be part of our EPS, right? So it's just a topic that's part of EPS. We're just setting basically the ground rules for EPS in this first lecture. When you go on to ClickUp, you will find that share capital is actually a folder in your EPS learning area. So when you go on to ClickUp, this first lecture is going to have its own little section where I've put all the questions and all of the slides that relate to this specific lecture in a separate folder. So from Thursday onwards, the lectures that we're going to be covering from Thursday onwards will be in your main learning area. Let me show you, because I think I might not be doing it justice. Okay, I'm just going to show you just now. So basically, what I'm saying is, when you go on to ClickUp, okay, can everyone see my screen now? Just give me a thumbs up in the chat to let me know if you can see where I'm at. So this is our ClickUp, right? So we're going to go here into Back 200. I'm going to put on student view so that you see it the way, so that the screen here displays the way you will see it. So this is what you see. And then we're going to go down to our learning area. So that's our learning area. If we go into EPS, right? So I've clicked on EPS. So here at the top, you can see the path that I've used. I've gone to learning areas and then I've gone to EPS. And within EPS, I'm having this separate folder. And this separate folder is in capital letters. I've said share capital. And in that folder is where you're going to find the slides for this specific lecture, as well as some solutions and questions that I've put up just to refresh your memory. So this lecture is just supposed to be a refresher, right? Then when we go back to, so I've gone back to the EPS, the main learning area. If I go back to the EPS section, you're going to see I've got slides here, but I've got a little comment in red at the bottom. And that comment says, this file or these slides are only from lectures 2 to 6, because lecture 1 is sitting in here, right? So lecture 1 is sitting in the share capital folder. Now, I've also got notes here, and these notes are the notes that you're going to use for this section. And then all of the other bits and bobs that relate to EPS, which we'll get to on Thursday. Okay, so that's what I'm trying to tell you. So this section and the lecture that relates to this section is actually sitting inside your EPS in a separate folder. Now, so let's talk a little bit about share capital. So share capital is super, super important for EPS. And as a result, we're just going to do a refresher on on share capital. Share capital, there isn't a specific chapter in your green book. So this green book for the entire of EPS and share capital, you're not really going to want to use this green book here, the introduction to IFRS. Instead, in your blue workbook, right, on page, I think it's like 190 or something. It's 182, right? So on page 182, you're going to see chapter 13, which is the share capital chapter. And then they've got about 10 pages until 192. They've got about 10 pages of notes. Okay. So what I've done is I've compiled these slides that we are looking at today to just summarize those 10 pages, so that you must read the 10 pages and use my slides as the beginning of your summaries, at the beginning of your studies, and then you alter and change and add or minus from my slides what you think is important. Right? But for our purposes today, we're not going to go over every single thing. So basically, the textbook will tell you about, what are authorized shares, what does it mean when a share is issued, that sort of stuff. Now, those things are fairly basic. It's stuff that we would have covered in first year, or even before first year. So we're not going to go through that stuff in detail. Instead, I just want to focus on some of the more tricky areas. And so what you'll find is that this specific lecture might go a little bit fast. So I want you to go back and watch this lecture when you have a chance, right? So go back and watch this share capital lecture, or share capital portion of this lecture, because we might go a little bit fast during these slides. So we're just going to focus on preference shares, right? And then I want to look very briefly at what happens when we issue shares and we get money in return, right? And that's what I'm calling here a change in resources, right? So additional resources. And then sometimes you issue shares and you don't get any money in return. And that's what we call there's no additional changes in resources. Okay, so we just want to focus on those basically 3 areas today, because that's going to become very important for us when we start doing EPS, right? So just pay attention, and then when we're done with the lecture, go back, read the textbook, go over the slides, and maybe watch the lecture again so that you get everything. Okay. So firstly, I'm going to talk a little bit about shares. So there's broadly 2 types of shares, right? We've got what we call ordinary shares, and then we've got these things called preference shares. Now, preference shares have different characteristics We're going to talk about the characteristics separately in a few minutes. But for now, just think about the two types of shares. Let's explain ordinary shares, right? So ordinary shares are shares that are subordinate. The word subordinate means they are the lowest class of shares, right? So they're the subordinate class of shares, the most subordinate, meaning they are the lowest class of shares. Okay, a class of share just means a group of shares with similar characteristics. So ordinary shares are subordinate to all other shares, meaning that they are the lowest class. But the one characteristic that they all have in common is that they all have voting rights. Okay, so they might be subordinate. In what sense are they subordinate? When they get paid out dividends. In the case of a liquidation, when a company is liquidated, they are subordinate, they'll get paid last. Um, but the one thing that they do have is voting rights. Okay, so that's one positive. So why are the shares structured in this way? They're structured in this way to try and mimic, right? To try and mimic um, owning the company. So they are the essence of what it means to own shares in a company or own part of a company. If you think of it, the owner of a company takes on all of the risk, right? When they take on the risk, they should be the one that should be negatively affected if the company fails. So that's why ordinary shares are subordinate to all other shares, because when the company fails, they get paid last, and sometimes they don't get paid at all, right? So if you look at what happened with Steinhoff, which is one of the companies listed that was listed on the JSE in 2017, in 2016, there was fraud discovered, and then in 2017, they went bankrupt. What in effect happened was the shares, the people that owned those shares, the shares were worthless, so they lost all of their money. And the reason why is because they were ordinary shares, they were subordinate to all other types of shares. They do have voting rights because if you are the owner of a company, you generally can make decisions that affect the company. But you might, if the company fails, you might not get paid out your fund. So you see how ordinary shares almost you know mimic the owning of the company. Okay, so it's very similar to you owning like a small business when you have an ordinary share. The important thing about ordinary shares is they might not always get dividends from year to year. The dividends are what's called declared, and only when they're declared do the ordinary shareholders know that they're going to receive dividends. If there's no dividends declared, they will not receive dividends. So there's no guarantee that they're going to get dividends, and there's no guarantee of the amount of dividends they might or might not get. So those are ordinary shares. For the most part, we sort of understood what that means. Now let's just talk just briefly about preference shares. So preference shares, just like the word dictates, are preferred to ordinary shares. But when are they preferred? They are preferred in the case of liquidation. Okay, so ordinary shares are preferred to ordinary share so let's say it again. Preference shares are preferred to ordinary shares in the case of liquidation. Okay, so when the company is liquidated or when the company fails, the preference shareholders will be given money before the ordinary shareholders. That's simply what it means. Okay. Generally, preference shareholders will not receive many voting rights. In some cases, they might receive half of the voting rights that ordinary shareholders receive. But in the majority of cases, specifically companies listed on the JSE, they have no voting rights. Okay, so they don't get a right because they're not true owners. They are a type of a lesser owner, preference shareholders, right? Whereas ordinary shareholders are the true owners. That's why they take on the most amount of risk, but they can make the most amount of decisions. Preference shareholders are sort of They want to be owners, but they're not true owners. So then they get a sort of fixed income, and so therefore they can't make all the decisions because they are acting as if they are like a bank, like a loan. So as a result, they don't always have voting rights. The one defining characteristic with preference shares is that they always have what's called a fixed dividend. So the dividend percentage is determined at the point of purchase of the share. When you purchase the share, they'll tell you you're going to get 10% dividends. Okay? So that is what preference shares are about. So on an annual basis, preference shares generally have a fixed dividend. So now I'm putting up a small slide about how, in the case of a liquidation, who gets paid, right? So at first, people who have a case or a law court has ruled against the company, they'll get paid first. Then the liquidators take care of themselves, right? The lawyers and the accountants, they sort of take care of themselves. They want to get paid from the dying company before anyone else gets paid. So that's them there. Now, certain companies and banks will have what's called secured debt. Secured debt means when you buy, so some of you people might have parents that have purchased cars. So when your parent purchases a car, the bank says, okay, we will give you the money to buy the car, but in the case that you don't pay us back, we're going to take your car. So they securitize their loan. The bank securitizes their loan. This is what is called preferential creditors, because the creditors actually have a claim to something. It might be a building or a vehicle or a plant or a machine, but they have a claim to something. So those people that have a legal claim to something are then paid out. Then we have what's called debenture holders. We're going to get to debentures just now. Debentures are just a type of loan. It's not 100% a loan. It's a type of loan. And then you guys would be familiar with what we call trade creditors. They are called unsecured creditors because they don't have a claim to a specific piece of something, right? So they can't. So for example, they sell you inventory, but then when you get liquidated, they can't say, okay, I want that item back because I sold it to you. They don't have a claim to it. They don't have a legal claim to it because they concluded a sale and they recognize revenue in their accounts and we recognize inventory in our accounts. And so they don't have a specific claim to it. And as a result, they will get paid a sixth. Then is what we come to and we call the preference shareholders are paid out. And then the ordinary shareholders get the remainder, whatever is left over. And sometimes, a lot of the time, there's nothing left over, right? So they get nothing. So they are paid last. Okay. So we've got 5 characteristics. So this is now, we're talking about preference shares. We finished describing ordinary shares and preference shares. Now we want to talk about the characteristics of preference shares. We've got 5 characteristics. The first 3 characteristics that we're going to discuss is going to describe something about dividends, right? Something. It's going to tell us something about dividends. The last 2 characteristics that we're going to talk about today is going to describe something about the capital invested. When I say the capital invested, what I'm talking about is the amount that the holder of the preference share gave to the company, right? So you would remember that it would say, you know, there are 400 preference shares in issue and they were issued at 10 Rand. So the capital invested is that 10 Rand per share. Right? That's what the capital is. But then they'll also say, you know, there's 400 shares in issue, they're issued at 10 Rand, and they are 10% shares. That 10% is what they call dividends. And that the first 3 characteristics is going to be talking about dividends, the last 2 about the capital. So let's have a look at the first type of dividends. So the first type of dividends is the cumulative dividends. Now we've dealt with this word cumulative before, cumulative. It simply means that we're going to add on to the previous dividends, right? So what accumulative dividends means is that there's a legal obligation for the company to pay the dividends. Now we know that the dividend is a fixed rate, it's generally a percent. There's a legal obligation for them to pay that fixed dividend annually. So they can't avoid it, right? Very similar to a loan. If you think about a loan, we can't tell the bank, oh, I don't feel like paying interest this month, right? It doesn't work like that. In the same way, accumulative preference shares are shares where you can't escape the dividend. You have to pay it, right? And what happens if you don't pay the dividend in 1 year? Just like interest, it will accrue, it will add on, it will accumulate over time. So you must add on, and every year you need to account for this dividend. So whether you pay it or not, whether you declare it or not, you need to account for it. So there is a situation where you might not be paying dividends for an extended period of time, where you need to create a liability for dividends and keep that liability until such time that you do pay it. Okay, so that's accumulative. The one trick with accumulative dividends is you cannot pay any other dividends, whether it be to other preference shareholders or whether it be to ordinary shareholders. You can't pay any other dividends until you've settled your cumulative dividends. So until you settled the balance outstanding. Okay, so that's cumulative preference shares. Okay, so cumulative. Now let's look at non-cumulative. So non-cumulative obviously is the opposite of cumulative, right? It means so we have dividends at a fixed rate, but we are not forced to pay it every year. So it's at the fixed rate, so it's at 10% of the dividends, or 10% of the capital, but we are not forced to declare it and pay it every year. So when would we pay this type of dividends? Well, before we pay ordinary share dividends, we have to pay this non-accumulative dividends. Okay, so non-accumulative, it won't accumulate in the year that we don't pay it, but in the year that we do pay ordinary share dividends, we must first pay the accumulative share dividends. So we must first pay the non-accumulative share dividend. So under the case of accumulative, it accrues from 1 year to the next. It's all, we can't avoid it. Under non-accumulative, you can avoid it, but when you avoid it, you can't pay ordinary share dividends. Okay, so that's just the difference, right? So cumulative, it accrues from year to year. Non-accumulative, it doesn't accrue, but you also can't pay ordinary share dividends if you don't pay it. Okay. Any questions so far? Okay. If you have any questions, just pop them into the chat. For the most part, we sort of know the stuff already, but we will go through it. We are going to go through it now. So participating preference shares is what I call a share that has 2 bites at the cherry. Right? What does that mean? That means that they will get their fixed dividend, which is common with all preference shares, right? They're going to get their fixed dividend, but in addition to that fixed dividend, they are going to participate in the ordinary shares, right? They're going to be added on as a fake ordinary shareholder. So when we calculate the dividends for this class of preference shares, we would say, give them their 10%, for example. And then when we're calculating ordinary shares, we need to include them in the ordinary share calculation. And they will get an additional amount from the ordinary dividend. So they get 2 types of dividends, preference share and ordinary share dividends, this specific class, right? So only participating preference shares do that. So now we've spoken about the first 3, and the first 3 are all about the dividends, right? They're just talking about the dividends, cumulative, non-cumulative, and participating. Now, in the next slide, we're going to start talking about what happens to the capital. So let's have a look at that. So I've got a little rare, what's this, a mustard colored box here. Why are all the numbers jumping around? It seems like the slide has changed since I've made it, but anyway. So if we look at this specific type of dividends, they're critically important for EPS, right? So the topic that we're going to start, and we've already started today, but the topic that we're going to continue on Thursday, this convertible preference shares are very important. So convertible preference shares, all it's trying to tell us is that in the future, these shares can potentially become ordinary shares, right? So they're not ordinary shares today, but in the future, they could become ordinary shares. They are convertible into ordinary shares. So they're preference shares today, but in the future, they may be converted into ordinary shares. They can be converted by 3 different methods, right? The first method is at the option of the holder, meaning the person that bought the share, right? So they can be converted at the option of the holder, meaning the holder can dictate when it needs to be converted. Then we can have shares that are converted at the option of the company, meaning that the company who issued the share can dictate when it needs to be converted, or mandatory convertible shares. Mandatory convertible shares is when there's a substantive condition, there's some sort of condition that must be met before the share is converted. And the share must be converted when that condition is met. For the majority of shares, and the ones that you're going to see, the suspensive condition is a date, right? So on this specific date, it is mandatory that all shares are converted into ordinary shares. All preference shares, that is, are converted into ordinary shares. So that is the 3 different methods. Convertible shares are just preference shares that can be changed into ordinary shares in the future. Okay. Now, redeemable preference shares. Redeemable preference shares are shares in which the capital amount will be paid back to the holder, right, at a specific, after a specific thing happens. So it just means that the capital will be paid back to the holder. The methods are exactly the same as convertible shares. It can be at the option of the holder or mandatory at a specific date, right? And if it is at the option of the holder or mandatory at a specific date, we consider it to be a liability. Because if you think about that, it's like a loan, right? So it's very similar to a loan, because a bank can ask you to pay the money back whenever they want to, or you're going to have to pay the money back at the end of the month, and you need to pay interest. So the dividends in this case looks like interest because it's a fixed amount. And if it's at the option of the holder or mandatory at a specific date, it has all the characteristics of a loan. And because of that, under those 2 circumstances, we will classify these types of redeemable preference shares as a liability. But if it is at the option of the company, right? So the company decides when the amount is redeemed and if the amount is redeemed or paid out, then it's not like a loan, because that's not how loans work. Then it is more like equity. So we will account for it as equity. Okay. Do you need to worry a lot about splitting shares between preference shares between equity and liability? No, not for EPS, not for this section. But it's just important. So I just wanted to let you know that that's a possibility. Okay. Any questions so far? Any questions? Okay, seems like there's no questions. So now I want to talk about what happens when the share capital changes and there's a change in the resources. Now I want you to think of the company and its resources as a pie. Okay. If we issue shares and we get money back, the pie is increasing. There's a slice of pie being added to the total, right? So in that case, the pie is becoming bigger because there's more money being added to the business. Okay, and when does this happen? This generally happens when we issue new shares that were previously unissued. And when we issue these shares to the public, or if we issue them to individuals, they will give us money, and we will use that money in the business to do whatever the business is doing, whether it be construction or some sort of service or whatever. So that's when we issue shares, there's a change in share capital, but there's also a change in resources. There's an addition of resources. It can work the other way around too, in that where we decrease, we buy back our shares and we give them back their money. But don't worry too much about that for back to 100. That is it's just possible to happen in the opposite way. But for us, we're only going to be looking at increases in shares. Okay. With a public company, what happens is a public company will invite people to apply for their share. They'll invite the public. Now, a couple of years ago, around 2010, MTN invited a lot of people to apply for their shares. They were called MTN Zakele shares. So what happened is people were going to post office and they were applying for their share. They were applying for their shares. They got an invitation, right? So the invitation was open to the public to buy shares, and you had to go to the post office, pay your money, and fill in an application form. And that is a process called prospecting, where you send out a prospectus, which is basically just information about your company, and you then give an invitation to people to buy shares. So that is the first step for a public company to get new shareholders, right? Is a prospectus. After a specific time, after a specific expiry date, the company will then look at all of the applications that they received, and they might have one of two scenarios, right? You might have a scenario that's called under-subscription, which means you offered 400,000 shares, but only 350 applications were received, and only money for 350 shares were received. In that case, you're going to allot 350 shares to the people that applied and give them the shares. Done. That's under subscription. The problem is that you're going to be left with 50 shares that you wanted to issue, and that 50 shares for which money you wanted to receive, but you just didn't get any. So that's a problem. But anyway, that's under subscription. Over subscription is where you said there's 400 shares that I want to sell. Does anyone want them? And then you got 450 applications, so more applications. In that case, what you're going to have to do is allot the shares in a proportion for the amount that people bought. So if someone bought 10 shares, they might only be getting 8, right? And someone bought 1, they might only be getting, half a share. But in that situation, you then need to refund the people that paid for the extra 50,000 shares, you need to refund them. Okay. So that's basically shares, where we issue shares and we get money for it. Now I'm going to talk a little bit about why the slide is so different to the ones that the way I created them. They seem to the words seem to be overlapping. Anyway, with changes in shares, we can have a change in the shares, but no change in the pie, right? So the pie doesn't get bigger or smaller. The pie stays the same size, right? So there's no new money coming in. There's no debit bank. We're not going to pass that journal entry, debit bank. So we're dealing with the cases where this is the case, where there's no debit bank. There's no increase in resources. Let's talk about share splits, right? But what I want to say is just briefly, with regard to changes in share capital with no additional value, the one that you need to focus on, and the one that we are going to be spending a lot of time on when we do EPS, is capitalization issues, okay? The others, I'm going to explain them, but it's not super important for you to. The only time you're going to get it is a discussion question, right? So a small discussion question. So, but don't I don't expect you to do journal entries and that sort of stuff, hectic stuff like that in the test on the other two. But you must go over the tutorials. As long as you are able to handle the tutorials, you'll be fine. So share splits. Share splits is when we split the number of shares that we have. But this is important now, guys. We split all the authorized shares and therefore, obviously, all the authorized shares, that means all of the issued shares as well will be split. So basically, we have a situation where we had 3,000 shares, but we wanted to have 5,000 shares. So we split all of the shares, those that were issued and those that were unissued. And that's what a share split is. So a share split, the ratio between issued and authorized does not change, right? So if you had, let's say, 10,000 shares authorized and 5,000 were issued, if you did a share split and you said every one share is now split into two shares, you would now have 20,000 authorized shares and 10,000. So it went from 10,000 authorized shares, it went from 10 to 20, and then with the issued shares, it goes from 5 to 10,000. So the ratio is still 50% of issued shares. The ratio between authorized and issued doesn't change. When does a company normally do this? A company would normally do this when they're trying to lower the share price. The share price is too high, and they want to try and decrease it. When the share price is high, it might mean that no one wants to buy the share because it's too expensive. So they try and decrease it by splitting the shares. How does it decrease the shares? Let's have a look. So if we had, let's say, 3,000 shares in issue, so we've got 3,000 shares in issue, and we want to lower the price because the price is at 5 Rand, right? For that 5 Rand, in the past, we had received 15,000, right? So that would mean the average price would be in the market around about 5 Rand. With the share split, we're not going to increase the resources. So the resources will stay at 15,000. That's why after the split, you see it's still 15,000. But the number of shares increase. So the shares go from 3,000 to 5,000, which means that the cost per share goes down. So this is an example where the company wanted to lower their price of the shares, so they split them. Okay, that's basically what it is. A share consolidation is the opposite of a share split. Instead of splitting the shares, you're now saying every 2 shares, let's say, that are in issue and that are authorized are now 1 share. So if you started off with 10,000 shares in issue, 10,000 authorized shares, and you had 5,000 shares in issue, and now you said, okay, all the shares that are out there, every 2 shares are now 1 share. You would then have 5,000 authorized shares and 2,500 issued shares. So again, the ratio between issued and authorized does not change under share consolidation. Again, I'll repeat it, the ratio does not change, right? We generally do it when we're trying to increase the price of our share. So if you look at this example, brief example, we had 5,000 shares in issue at 5 Rand, and we had received 15,000 amount of 15,000 in the past for this 3,000 shares. But now the share price is too low, so we want to increase it. So we kept the 15,000 as is, but we decreased the ordinary shares to 1,500, which means our share price increased, okay, to 10. Okay, so share splits, the important thing about share splits and share consolidations is that the ratio doesn't change, right? That's number one. And when the split is happening, it changes both the authorized and the issued shares. Changes both the authorized and the issued shares. I know that we're over time, but we're almost done. So I'm just going to push forward and go to the end. We've got about 5 slides left. So with capitalization issues, the difference now between share splits and capitalization issues, because remember, in both cases, in both share splits and capitalization issues, you're going to have an increase in the issued shares. But the difference between the two is that with capitalization issues, there's no change in the authorized shares, which means the issued shares might be changing, but the authorized shares are staying the same. Therefore, the ratio between issued and authorized will change. Okay? So that's the difference. So basically what happens with a capitalization issue is we say to the holders of ordinary shares or whatever type of share it is, we say to them, we are going to, if you're holding 1 share or 10 shares or however many shares, we're going to give you an extra bonus share. So in what circumstances does a share consolidation issue occur, and why would the company want to increase the share price? So if a company has newly been listed on the JSE, they might have a share price that is very low because no one knows about them, right? When your share price is very low, it might look like, and you're not issuing any dividends, it might look like you are what's called a penny stock, a useless stock, right? Your share is useless because it holds no value. So companies that want to make themselves look better on a list, on a stock exchange or on the JSE, will want to artificially push up their share price a little bit so that they no more consider to be a penny, right? And people start to take them a bit more seriously. So that's generally when you're newly listed, people do share consolidations. And then when you're a very big old company, let's say like your British American Tobacco, which is one of the biggest companies in South Africa, listed on the JSE Stock Exchange. It's got the highest cap, right? And their shares are like 400, 600 Rand a share. Now they're too expensive because someone has to pay so much for them. They would do a share split because they're so old and they're so big. Whereas a company that's new will want to try and get out of their share costing, like 1 or 2 cents. They want to actually have a share that's a Rand or so, or so more. So they will do a share consolidation to try and make their shares look better. That is when they'll do a share consolidation. Okay, so a capitalization issue is where you say to people, you're holding 2 shares, let's say, and I'm going to give you a free share. I'm going to give you a bonus. I'm going to give you a share for free. So that's what a share capitalization issue is. You're giving someone a share for nothing. Generally, companies do it in lieu of or in exchange of dividends. So they will not pay dividends. Instead, they will give them something of value, that being the share, for free. So they say, we're not going to pay you dividends, but we're going to give you this money. Generally, a company will do that when they want to try and keep as much money as possible in the business for growth purposes, right? So they want to try and keep as much money as possible, cash flow in the business, so that they can use it to implement it to buy a new plant or to, engage in a new project or something like that, to try and boost profits in the future. And when they do that, shareholders can get unhappy, and shareholders can say, listen, I bought this share, but I'm not getting any dividends. So then the company will say, okay, in exchange of not giving you dividends, we'll give you a free share. And that's what a capitalization issue is. But remember, with the capitalization issue, the number of shares in issue will change, right? Because you're going from having, let's say if there's for every 2 shares you get 1 share, you got 2,000 shares in issue, you're going to give 1 share for every 2 shares. So you're now going to have 3 shares being issued, or 3,000 shares in total being issued. So the number of issued shares is changing. That's my point. The number of issued shares are changing, but the authorized shares are not changing. So the ratio between authorized and issued will change in a capitalization issue. Okay. Now, when we pass this type, or when we have this type of journal, this type of situation, we are keeping the pie the same. So the pie is not changing, but the allocation between the different parts of the pie is changing, right? So something that we, for example, had and amounts that we're keeping in the company, we try and call it retained earnings or earnings that have not been distributed, right? So it's another word for retained earnings is earnings or income that has not been profit that has not been distributed. So we keep that in the company. But now when we have a capitalization issue, we need to pass a journal entry to show that even though we're keeping this amount in the company, it needs to be re-allotted. It's no more retained earnings, it's no more profit undistributed. It is actually being used to cover, to pay in a way for the shares. So in our example here, we've got 2,000 shares at 1 rand. So our share capital should be 2,000 rand. And then we say, if you can get an extraordinary share if you have 5 shares held. So 2,000 shares in issue, you get 1 share if you have 5 shares held, which means we need to take 2,000 shares divided by 5, right? And that's going to tell us that we're planning to issue 400. So that is how we got this 400 here. It's 2,000 shares divided by 5 shares, and then we know that we want to issue 400, right? And then we multiply that by the average share price. And the average share price is, in our case, 1 rand a share. We get an amount of 400 rand, and that amount is the amount that we journalize. We move it outside of retained earnings, meaning we decrease retained earnings, and we want to try and increase our share capital or ordinary share capital, and we do that by crediting it. So that's the type of journal entry that I'm talking about. That is just so the pie is not changing. There's no debit bank. The pie isn't changing. Instead, what we're doing is we're allotting it within the pie. We're changing it within the pie. Right, so this is what that would look like on the changes in equity statement. We are simply going to have a decrease under retained earnings of 400 rand and an increase under a share capital of 400 rand, and we'll name it capitalization issue in the statement. Okay. Yeah, so you notice, so what I'm trying to say here in the statement at the bottom is if you have a look at the total at the beginning of the year was 3,000 rand. At the end of the year, it remained 3,000 rand. So there's been no change in the total pie, but just the allotment has happened within the pie. Change has happened, adjustment has happened within the pie. Okay, so we've got 2 slides left, so we're almost done. Debentures. Debentures are basically loans, but they're not loans that we get from a bank, right? They're loans that we get from individuals, people. Now, why would we want to do that? Why would we want to get a loan from a person as opposed to a bank? Well, number one, it can be quite complicated to get a loan from a bank. Banks might want security. Remember, we spoke about securitized or preferential creditors. So banks might want to say, okay, I'll give you a loan, but I'm going to take your building, or I'm going to take ownership of your building. And if you don't pay me, I will take the building, right? So that's the one thing. The next thing is sometimes companies might be operating in different countries where they can't get a loan because they might not be registered in that country. So that's the other thing, if they've got foreign operations. And then sometimes it's just administratively difficult. There's a lot of paperwork, there's a lot of stuff that you need to do. So what they will do then is they will go to a lending partner or an individual and they'll say, I'm going to give you a bond, which is a type of loan, if you give me your money. And that transaction generally is quite quick, so there's not too much paperwork. And if there is, all the paperwork is within the company and doesn't need to go out. And so you can have that sort of transaction pretty fast. So that's the first thing. And the next thing that's interesting about debenture is that the holder of the debenture, the person that gave the money to the company can now sell this debenture to someone else. So they can transfer the loan. They can say, okay, you no more owe me, you now owe Joe Soap, you owe someone else. And then Joe Soap can also sell it, and it can be transferred multiple times. In America, they don't call these things debentures, they call them bonds, right? So if you're watching any sort of investing videos or American videos, you'll hear them talk about bonds, company bonds, corporate bonds, or they might talk about government bonds. So in South Africa, we call them government bonds, but when it comes to the corporate bonds, we don't call them corporate bonds, we call them debentures. It's just a very British thing to say, right? So it's a very British style of speaking. So debentures are simply loans, and they're transferable, and they're generally with a specific individual. Now, because they're loans, we need to recognize them as a liability, right? That's obvious. And they tend to have a fixed interest rate. Now, just like cumulative preference shares, we can't avoid that interest. Regardless of whether we pay it or not, we need to accrue for it, okay? So it's mandatory that we accrue for debenture interest. Okay, and this is our last slide for today. Very important, again, see the mustard sort of block that we've got on this page. Here's the mustard block here where the plus or asterisk is appearing. Very important for EPS are the potential ordinary shares, right? So convertible debentures are debentures that can be converted into ordinary shares. Now, have we seen this before? Yes, we have. We've heard about convertible preference shares that can be converted into ordinary shares. Now we're talking about convertible debentures that can be converted into ordinary shares, right? Again, there's three methods. It can be at the behest of the holder, so at the option of the holder. It can be at the option of the company, or it can be at a mandatory date in the future, so at a specific time in the future. So under all of these circumstances, these debentures are considered liability. So there isn't that split like we have with preference shares. They're always considered liabilities. But when they are converted into ordinary shares, they would change from a liability and now become an equity instrument. Okay, so that's the important part. The important part is that they are not equity, they are not ordinary shares today, but in the future, they can become ordinary shares. So we need to remember and just think about that and remember that. Okay, so guys, we went over time today, but if you have any questions, so what are we supposed to do when we leave this lecture? Go into your blue book, your workbook, and read chapter 13. Starts on page 182 until 192. So 182 to page 192. Read that on share capital. Then go and try the 4 questions that are in that chapter. They're not super difficult. All the solutions are on ClickUp. So try to attempt them. When you struggle to complete them, or if you struggle to complete them, should I say, go and look at the solutions, and then rewatch this lecture. And then if you have any questions, please come during my consultation times. I've got consultation times on every day that we have a lecture. So half an hour before the lecture and half an hour after the lecture, we are in consultation. Okay, so I'm going to stop the recording right